Good morning and welcome to the June 2025 edition of the Blackfinch Asset Management 10-minute market forecast. Thank you very much for joining us this morning. My name is Mark Keogh. I'm head of Blackfinch Asset Management, and I'm joined today by Dr. Dan Appleby, our CIO for Blackfinch Asset Management and our ventures business. For those that are new to our webinar, we take this time to cover important events that have occurred over the last month within a focused 10-minute presentation, as well as highlighting what is on the horizon that we believe are especially important to look out for over coming months, providing you with the information you need to answer the questions your clients may have. If you do have any questions during the presentation, please feel free to submit using the Q&A box at the bottom of your screens. We will answer those questions after the broadcast is finished, or you can contact us directly. Before we begin, it is important to note that the details covered this morning are intended for professional advisors only. The areas covered should not be taken as financial advice. And in today's session, we have three important topics to cover. First is understanding what the impact of tariffs has been to date. Secondly, thinking about tax cuts in the US and whether they will support a market rally. And finally, we'll talk about and discuss how investors should position their portfolios given the uncertainty in today's markets. So I'll now pass over to Dan to get into the detail. Good morning, Dan.
Thank you, Mark, and good morning, everyone. Now, I'm going to carry on a theme that Josh introduced last month, which was comparing the hard data we've been seeing with the soft. So with the hard data, for example, the negative GDP growth in the US for Q1 versus the soft survey data as potential predictors of what's to come next. And there's been a bit of a massive gap emerged actually between the soft and the hard data at present. And this is pertinent because it separates the time before the tariffs were imposed and the potential consequences of these tariffs moving forward. Now, aside from the tariffs that have dominated headlines, really, we also have the big, beautiful bill moving through Congress, which I do quote directly as the name of Trump's tax cutting policy. Now, in his first term, tax really did support markets moving higher. So the question is, are we likely to see a repeat this time round? And finally, with all of the political and subsequent economic uncertainty we're seeing, I'll end on how investors may want to position their portfolios to withstand some of this volatility that we are seeing. So on this first slide, before I cover this chart, just a quick recap of the potential warning sign in the hard data. And it was that GDP figure for the US in Q1, and it came in at a revised negative 0.2%. Now, this was heavily skewed by businesses front-loading imports to beat the tariffs. And that may seem to be subtractive from GDP growth, given that imports simply do mathematically just subtract from the final result. But it is important to note that this is accounting for the fact that GDP is, of course, a measure for domestic production. And what was happening in Q1 is businesses were stockpiling inventories, and that is investment spending that adds to GDP. But as this was spent overseas on importing goods, then imports subtract from that GDP. So we're not accounting for that, and we're only looking at the domestic production. Not that imports are negative for a country's GDP growth. But if we look through that volatility in the data, actually the underlying US economy looks quite good. Other hard data, say on the labor market in terms of job creation and low unemployment rates look robust as well. However, this is backward looking to a large degree up to, say, the end of March and April time, and we're still very early in Trump's trade war for this to feed through to the data. The soft data is signaling potential impacts of this trade war, the likes of low consumer confidence surveys, and also what this chart is showing on the slide here. And this is showing a measure of how many businesses are planning capital expenditure in the next 6 months. So if we read the chart here, only 18% of businesses surveyed are planning to invest in the coming months. And this is the lowest point since the pandemic. And it has only really been lower during the financial crisis, as this sort of dashed red line is showing us here. Now, the difficulty for businesses, and I suppose investors at that, is policy right now can change on a tweet. So it becomes very difficult to plan and commit to investment going forward if we don't know what's going to happen. Now, ultimately, this may drag on growth, job creation, and that will show up in the hard data. So the signs are that this trade war will not be good for the US economy, nor the world economy at that as well. And it hasn't been particularly good for the US stock market so far either. Now, aside from the tariffs, one big catalyst on the horizon is this big, beautiful bill. So Trump's second round of tax cuts. Now, before I refer to this chart, if we remember back to 2017, Trump's Tax Cuts and Jobs Act, as it was called at the time, it really helped the S&P 500 rally. It was about up 20% in 2017. So for that year. Now, although the bill didn't pass till the end of December, what happens is the stock market gradually prices in news, and it was the big cut in the corporation tax rate that was estimated at about 10% under the S&P's earnings in the year ahead, which really helped. So the question is, will we see a similar outcome this time round with the big, beautiful bill? So where are we so far? It just narrowly passed the House, and it will now make its way to the Senate. And the Republicans do hold a majority in the Senate as well. But it's still not a given it's going to pass. There are already being concerns raised within Trump's own party, with phrases like debt bomb being used to describe this bill. And notably as well, Elon Musk has criticized it as undermining his work in DOGE, or that Department of Government Efficiency, that government spending cut initiative. Now, the question is, are these concerns valid? And I think it's fair to say that they are if we look at this chart on the slide here. Now, this shows the US federal budget deficit. And this is simply measuring revenue generated by the government, mostly from taxes, less the spending does. It does as a percentage of GDP, just to normalize that figure. And we can see this is firmly negative because the US government is simply spending much more than it makes. Now, this dashed red line here shows where the deficit was the last time Trump passed a tax bill through Congress, which was around the negative 3% mark. Now, today, the deficit is twice that at about minus 6%. So a much worse fiscal situation this time round. And if the big, beautiful bill passes, estimates show that this deficit will widen to 9%, and it'll add about 4 trillion to the deficit when measured in dollars. So unlike the first time round, when equity markets rallied on the prospect of those tax cuts, what we've seen so far is a bond market sell-off, with the 30-year Treasury spiking to over 5.1% in yield on the day the House voted. Now, in the UK, all we have to do is remember what happened to Liz Truss when the bond market didn't like her fiscal policy. Now, it's a very different political system in the US versus the UK, and Trump certainly won't be ousted from his presidential seat anytime soon. But it would be a risk for him to ignore the bond market if this big, beautiful bill isn't revised in some form. But the Senate will have its say first. And on this last slide, so what does this all mean? I suppose, and more importantly, what the question for investors is, what can we do about all this uncertainty in the US today? I should note, though, that it isn't all downside risks stemming from America, because corporate earnings have really been quite robust. So across the recent earnings season, the S&P 500 companies have grown revenue at about 4% year on year. Earnings have risen by about 11%. And it's really this growth in company earnings that have propelled US stocks high over recent times. And we can see this in this chart here, just looking at it a different way. So in this chart, we are seeing the US stock market's capitalization, or the value of the US stock market, over the world's stock market capitalization. And really, since the recovery from the global financial crisis, the US stock market has increasingly become a bigger proportion relative to everything else, really. And heading into this year, US stocks accounted for over half of the world's stock market. But as US policymaking uncertainty has crept into market pricing, we're now back below that 50% mark. Or we can look at it a different way. We can say that over half of the world's stock market is held outside of the US again. And this gives investors plenty opportunities to invest outside of America and in turn create that diversified portfolio to withstand some of the volatility that we are seeing and experiencing from erratic policymaking. Now, diversification, it's often said as it's the cornerstone of a well-constructed portfolio, and that is generally true. But in fact, just looking at it from a return basis, it would have actually been better to simply invest in the S&P 500 over the last 15 years. I was looking at some of the returns over that period. The S&P 500 was up 870% on a total return basis. We compare that to our counterpart in the UK, the FTSE 100, that was only up 269% as a comparison. And that outperformance this year has not played through. So when I checked last week, the FTSE 100 was up 9%, while the S&P 500 was down 6%. Now, investors, they will always want to allocate to corporate America. Earnings are always generally really robust. But with half of the world's stock market, again, being outside of the US, volatility really stemming from US politics, diversification really does seem to be, again, the cornerstone of portfolios. So in quick summary then, there is uncertainty stemming from the US today with tariffs and now a tax bill that looks to be undermining the goal of deleveraging the public sector in the US. But as is usually the case, corporate America looks robust, and the hard data so far suggests that the economy is holding up. But diversification across geographies does seem to be the solution for investors as they construct portfolios to try and weather some of this volatility that we are seeing. And with that, I'll hand back to Mark to wrap up today's session.
Thank you very much, Dan. I really enjoyed that. It's a shame that we're restricted to our 10-minute forecast, because I'd love to get into a Q&A on the discussion around diversification, active versus passive. But in the spirit of this webinar, I just would like to thank Dan again for an excellent presentation. I'd also like to thank all of you for joining us this morning. You'll see the contact details. If you have any questions, either post them in the webinar, or please feel free to contact myself or the team, and we'd be more than happy to cover anything that you may want to discuss, both the content of today and or any other questions that are on you and your clients' minds that you may need some support with. And with all these events, please feel free to tell your colleagues about these events. You know, they're focused, they're quick, they're to the point, and the objective is to give you that quick fire data that you can take away and use with your client meetings. So that concludes our broadcast for this morning. Our next 10-minute market forecast will be hosted on the 1st of July at 8:50 a.m. Please come and join us again for our latest update. On that note, I'd like to wish you all a great day. Have a fantastic week, and thank you very much for joining us this morning.